All right, we are doing our third tutorial on using Joe Massey's version 6.2 of the spreadsheet. So Joe and I are still in the studio together, and the first one we did a rental property, the second one we did a house hack. This third one, we've got the house hack numbers left in there, but Joe's going to walk us through the two other tabs on the spreadsheet, the long-term analysis and the long-term with cash flow to principal.
All right, so again, this spreadsheet, if you're coming up and joining us here, we've already filled out everything on our inputs tab. We've filled out our yellow highlighted fields, as you'll remember. We've put in, payments, down payments, interest rate, etc., all of our expenses. We've worked through our cash flow tab so we can see how much cash investment, what are our expenses, our annual cash flow, our returns, and most importantly, our ROIQ, our return on investment quadrant. Now, one of the questions that we get a lot is, well, what does this look like long term? All right, we're going to do a long-term analysis. So it's going to be a little more difficult to see here on the screen. There we go. Let me zoom in a little bit. So what you're going to see here, year number one, this is the cash flow tab that's just been shortened into just one column. We've taken off all the notes on each side. So $4,680 in cash flow, your property value when you bought it, or I'm sorry, at the end of the year from the appreciation, how much you've paid your mortgage down, how much equity you have in the property, and then your return on investment quadrant. Your property is appreciating. This is the cash flow. This is the debt that's going down on the property, and this is your depreciation for your total return on investment, 108.2. So this ties exactly with that first year, okay? Year number two, what you're going to see, rents go up. Why? Because we put in here an annual rental increase of 3%. Expenses go up. Why? Because some of these are tied to the rents, like repairs, etc. And then we've built in 3% inflation for all other expenses, things like taxes, insurance, utilities. The one thing that's not going to increase, Chris, you know what it is?
It's your mortgage payment.
Your mortgage payment. That's exactly right. Your mortgage payment is not going to go up because it is inflation protected. Also, your mortgage insurance is not going to go up. Now, that's assuming you have a 30-year fixed rate loan. If you decide to get an adjustable rate, all bets are off. It certainly could increase. But with the increased rents and your mortgage payment, which is your biggest expense, staying the same, you're going to see that your cash flow is going to increase. Your cash flow gets better. Therefore, your return on investment gets better. All right, property is still appreciating, a little bit more debt reduction. My depreciation is the same, but I'm making more cash flow. Then we're going to see we're going to see the same thing in year number three. We're going to see the same thing in year number four, year number five, and then this goes out. I've shortened it where you can see year 10, 15, 20, 25, 30, and 31. You can click on this here. I don't know if this works on a Mac.
I don't think it does.
It doesn't.
So what Joe's clicking on is there's a button to expand out the 5, 10, 15, 20, 25 years in between. But for some reason, on Macs, the Excel button doesn't work on there.
Yeah.
So not the end of the world.
If you want to analyze year number 13, you'll have to buy a Windows computer. Otherwise, just assume that year number 15 is going to be fine. But on a Windows computer, you can click on this button that says See All Years, and you can see every single year in here. But for our purposes, the year we really want to look at is year number 30 and 31, right? So we finally pay off the property at the end of year 30. In year 31, it is free and clear. We're going to make $63,000 per year on that property. My return on investment, my debt pay down, and my depreciation are gone because I can no longer depreciate that property. But my appreciation is very strong, and my cash flow is very strong as well. And then I can use this tab to analyze anywhere in between. If I think I'm going to sell it at year 15, what do I think my value is going to be? How much equity do I have? How much cash flow am I getting? All right, and I can look at any one of these years in here to see when might it make sense to sell this property.
And something I want to point out, too, because we're looking at year 5 and year 10 columns, you've got the mortgage insurance there, the $1,532 every year, but sometime between year 6 and year 10, it drops off. So you got the spreadsheet built in, so based on the down payment amount, the PMI will drop off.
That's correct. Once you reach 80% of the value of the property, that mortgage insurance will go away. So a lot of people say, hey, this is great, but you know what, Joe? I've got a full-time job. This $4,680, I don't really need this cash flow. Well, I think it's great to think about maybe we could do something else with that cash flow. What could we do with it? We could take it and apply it towards the debt. So this long-term with cash flow to principal, what you're going to see here, oops, let me zoom in a little bit. So what you're going to see, year number one, $4,680 is our cash flow. And then in red, all cash flows are reinvested to reduce the principal payment. So your cash flow to your pocket is $0. And we take that cash and pay down the debt. So what you see is your debt pay down goes up, your cash flow goes down, but your ROIQ stays the same. We've just allocated that money differently. And then the next year, we take all the cash flow, apply it towards the debt. All the cash flow, apply it towards the debt. Now, my debt is paying down quickly, but it's not impacting my mortgage payment. Why not, Chris?
Because it's 30-year fixed based on the original amount.
Exactly. It's a fixed monthly payment. And if I go over to the right here, somewhere in between year 15 and year 20, this property is going to be paid off. I happen to know, I can't see it on this one again because it's a Mac, but it's right around year 17 is when this property is paid off. So now in year 20, this property is free and clear, and it's cash flowing about $46,000 a year. So if I'm on a 20-year plan, I could buy this property, live in it for 1 year, move out, rent it out, take the cash flow and apply that cash flow back to the principal and have this property paid off in 20 years. What might be some reasons I would want to do that, Chris?
Well, for retirement planning.
Yeah.
I mean, that would be the main thing.
Yep. What if I wanted $46,000 a year to send one of my kids to college?
Yeah.
What if I wanted $46,000 a year to pay for my parents in a nursing home? What if I wanted $46,000 that I'm now going to use to buy another property? There's a million different things I could do with that. By taking that cash flow and reinvesting it, that allows me to pay that property off a lot sooner and achieve that financial freedom a lot earlier in my life. Other questions on this one, Chris? What do you think?
I like it. I mean, I like the long term with cash flow to principal because that's a very simplistic savings plan where you can say, hey, great, if I just take the cash flow and write one check a year and write it back towards the principal, great, I'll have the property paid off in what, 17 or 18 years, you said?
Yep. Depends on how much you put down, right? So if you put more money down, you're going to pay off sooner. If you put less money down, you're going to pay it off later. So if you put 25% down, like on an investment property, you'll pay it off in about 12 years. So it's a very function of how much you're renting the property for, how much you're putting down, and your overall cash flows.
No, so it's just a great tab to see some long-term modeling. Of course, I mean, I like the spreadsheet really for those first two tabs, the inputs and the cash flow, just because looking out, 20, 30 years, like a lot changes. And, who really knows what's going to happen? My life will be very different. The market will be very different. So look at this stuff, but I would, take it with a grain of salt because we're modeling out for 20 or 30 years. But keep in mind the big picture that this can show you off the power of buying property using leverage, so a low down payment, not paying in cash, and then having the patience of holding on to property, what type of numbers you can expect in the long run, because it won't be exactly what it's like, but this will give you a good gist of where things are heading and what your net worth and cash flow positions will be like out in 15, 20, 30 years. That's the part I like about it. It's exciting to me from that big picture, simplistic view.
Absolutely. I think you're spot on. All right. If you guys have questions, want to learn more, feel free to call Chris, call myself, email us. Would love to chat with you, talk about helping you purchase your next property, whether it's a primary residence, whether it's an investment property, or maybe you want to buy a multi-unit condo, whatever. Would love to chat with you.